I'm Amy Anderson for the OptionRally News team. Let's take a look at the global market review of last week's events and highlights. Wall Street suffers worst January since 2010. US dollar index gathering momentum, and Amazon takes a nosedive. Let's take a quick look at what's happening in the global markets now. Global stock markets tumbled sharply during the week after U.S. Federal Reserve decided to trim further monthly bond purchases by $10 billion to $65 billion on the back of improvement in U.S. economic data, suggesting that growth is accelerating. While developed nations assumed that the turmoil in the emerging markets is a result of high fiscal and trade deficit along with high inflation rates. Plunging currencies in the developing world, such as Argentina, Turkey, and Thailand, are also fueled global sell-off in the equity markets. Amazon slumped 11% after the world's largest online retailer reported profit and sales that missed analyst estimates. Mattel Inc. Sank 12% after a drop in Barbie sales weighed on results. Google Incorporated jumped 4%, pacing gains in technology shares after sales topped estimates on growing advertising spending during the holiday season. European stocks were down at the close on Friday. Markets were affected by poor Eurozone inflation and unemployment figures, as well as renewed concerns about a currency crisis in emerging markets. The Frankfurt DAX dropped 0.71% to 9306.48 points, while the Paris CAC 40 fell 0.34%. London's FTSE 100 was down 0.43%. In the foreign exchange markets, a report Friday showed U.S. consumer spending climbed more than forecast in December, even as income stagnated. Household purchases, which accounts for about 70% of the U.S. economy, rose 0.4% after a 0.6% gain the prior month that was larger than previously estimated, Consumer Department's figures had showed. Incomes were unchanged, pushing the savings rate to the lowest level in almost a year. The University of Michigan's final January index of consumer sentiment fell 81.2 from 82.5 a month earlier. Earlier this week, the Federal Reserve decided to reduce its monthly bond purchases by $10 billion. The dollar had its biggest monthly gain since May as a global sell-off of emerging market currencies prompted investors to seek the relative safety of haven assets. The yen gained versus the dollar for the first time in 6 months as a global rout spurred investors to reverse carry trades. The dollar appreciated 1.9% to 1.3486 against the euro. On the commodities front, the rally in the equity markets and increasing optimism over global economic growth in the past few months dented the appeal of commodities. Commodities have stuck in range, and they really need strong triggers for any strong move. However, the energy counter showed sharp volatility on weather concern. Natural gas is the outstanding performer of the market, hitting a 4-year high and then retreating from the higher levels on forecast for milder U.S. weather. Closure of the Chinese market resulted in low volume trade in commodities. This week we may see more price fluctuations in commodities as traders will rejoin the trading. Crude is less likely to stay above the mark of the $98 levels. Gold is looking weak, but silver appears to be weaker. Silver may touch $18 in coming days. The US ISM Manufacturing and Reserve Bank of Australia rate decisions should be watched closely by market participants along with other data while trading in commodities. This is Amy Anderson from OptionRally signing off. Follow me on Facebook and watch for our new financial terms of the day and our weekly event news. Have a great week.